Hey everybody, welcome to Tech Talk here at MarketStream.live. My name is Joseph Cusick with the Cusick Group Securities offered by MoneyBlock. This is where we take a look at some charts, some option pricing, give you some transparency and some potential moves in some underlying stocks. And the one I want to look at is Adobe Systems. They have earnings tonight, so let's jump in. Let's take a look. Adobe right now, you've seen what it's done on this previous earnings. It's basically coming off of just a straight up line to the upside. You continue to see that the stock trading 122 flat, basically up 2 cents today. This 122 level has been resistance up until today. It opened up and has pulled back subsequently. You have the 20-day and the 50-day moving averages coming in at 119 and 115 respectively. Those are areas that the bulls are going to be the battle zone, will come into play if, in fact, the stock starts to pull back. So now that we know where support is, we see that clearly. If you look at it over basically, we're at all-time highs basically. You can look back as far as 1990, stocks trading at all-time high levels. So what's going to be the catalyst to get this thing to new levels? I think the challenge right now in this environment is going to be more to the upside than it is to the downside. So we'll see if earnings are going to be a catalyst, but really, what do? First of all, let's see how much the actual stock is being priced to potentially move. That's where we look at the options. We clearly see that the stock has been in an uptrend forever. No, but specifically over the last 2 months. So what do? Well, we take the straddle strangle market in the options world. What is the straddle strangle market? Well, we type in Adobe symbol, ADBE. We scroll down, and basically you're going to look at the closest expiration month options. These are the March options. They're actually expiring tomorrow. So you take the straddle, the closest strike price to the stock trading, where the stock is trading. So the stock's trading at 122. So the 120 calls and the 120 puts are going to be the closest ones. That's the at the money strike. So you look at the call offer and the put offer, and then the strangle. That's the first strike out of the money put. That's the 115 puts. And the first strike out of the money call. That's the 125s. We add up all 5 of these, or 4 of these legs, right? Basically gets you to about $6 and some change, right? 360, 127, 32, 110. So that's a little over $6, almost $6.20. You divide that by 2, and that gives you with a 50% probability that Adobe could be moving in basically a $3.10 range between now and tomorrow. Or in other words, going into tonight's event. Can it move outside of that? Of course it is. But statistically, if you look at it, there is less than a 30% probability that it's going to be below 120. There's only a 10% probability between now and the end of day tomorrow that it's going to be below 115. Now, these strike prices are a little bit too close to comfort as far as what I'm concerned with, because I don't have a directional bias. As a matter of fact, I think direction is going to be very difficult to take advantage of in this particular juncture. So I'm going to take advantage of the implied volatility that's in the stock. Implied volatility, as a matter of fact, if you go to the charts, you can actually take a look and see, first of all, where Adobe's implied vol is. So I'm going to type in ADBE, Adobe Systems, and I'll go to the volatility chart. And right now, the implied volatility is currently trading. It's actually spiking up a little bit here at around 16, 18 level right here, 18. The average is 22, so it's slightly below the average. So implied volatility is a little bit low. Let's actually take a look at the seasonal chart. So there's not a heightened expectation of big violent move, but we're pricing in the potential of $3 either up or down with a 50% probability. The correlation line is right now is the coefficient is at 52%. So there's not a high correlation, but you can see right now that the range right now is it's hugging this line pretty closely. But unless it's over 70%, I don't have a high conviction that the correlation line is in play. The forecast is 20, 30, 40, and 50 days is higher, higher, lower, and higher. A little bit mixed here. So again, earnings could be the catalyst to get it to the upside, but the options marketplace between now and Friday is only pricing in the potential to touch 125 or get as low as 119. And I think that the downside is probably more of a risk than the upside. So what I want to do is set up a trade that's going to take advantage of a range, basically between 125 and about 120 or 115. So I'm going to go back into the options chains and let's take a look at Adobe. I'm going to give myself some time. Yes, volatility is relatively inexpensive, but if you actually take a look at it, I'm going to actually bring up the Greeks. Currently, right now, the implied volatility in the front month is 18th. That's with 1 day left. With 33 days left until April expiration, you have the April implied volatility at 25 on the puts, 22 on the calls, right? So basically, you're looking at implied volatility is in neutral. So it's not high, it's not low, it's neutral. I'm going to look at doing what's called a Condor. What a Condor is where you're selling an out-of-the-money call, and so I'm going to sell the 125s. Now, I don't want to do that naked. I'm going to buy another option above it. I'm going to buy the 130s. So I'm going to sell these at 238, and I'm going to buy 115. I'm also going to subsequently sell the 115 puts. These are the out-of-the-money puts. Now, you could do the 120, but remember, pricing in, we saw that there's the potential that it could trade as low as 19 going into the earnings event. So I'm going to actually sell the 115s, and I'm going to buy the 110s. I'm buying that as an insurance policy just in case the market goes through that strike price. So net, I am selling the 125 calls, buying the 130s as protection. That's a $5 credit spread, and I will receive a credit for that. Specifically, the credit's going to be 238 minus 115. So I'm basically taking in 116 for that, and I'm going to sell the 115 puts. So I collect $1, and I'm going to buy the 110 puts. I pay 50 cents, so I click 50 cents. So basically, you're looking at almost about $1.90, $1.95 in total credit received. There's $5 difference between what I'm selling and what I'm buying on both the put and call spread. Both these spreads at expiration cannot be in the money. So basically, I'm taking in $1.90 worth of risk. Worth of credit versus a risk of $2.90. The probability of potential success is right around 65%. So I'm going to put this in at a limit credit of 1.95. And actually, we can just put it in at 190. See if we can get filled a little bit, maybe better. And we'll review I got to put a number of contracts. 1. Now I'm putting in, actually I can do 2. I have $22,000 worth of buying power, $21,000 worth of buying power available. If I put up basically about $500 worth of risk, that's still below the 5% threshold that I put out there. And I am clicking review order. So you can see what I'm buying, what I'm selling, the total credit that I'm doing this Condor for. So my risk is going to be the difference between the strike prices, $5 minus the total credit, which is $1.90. So that's $2 and or $3.10 worth of risk is what I'm basically taking on by doing this order. Place the order, and basically I'll monitor it to see if I get filled before the end of the day. Okay, folks, that's it for Strategy Now, or Tech Talk, excuse me. I will be back at 4:30 Eastern Time and wrap up all the closing action here at MarketStream.live. Take care. Have a great day.